Today, we will talk about bond equivalent yield, BEY. Bond equivalent yield is a metric that allows investors to calculate the annual percentage yield for fixed-income securities, even if they are discounted short-term plays that only pay out on a monthly, quarterly, or semi-annual basis. With BEY figures, investors can compare the performance of these investments with those of traditional fixed-income securities that last a year or more and produce annual yields. This enables investors to make more informed choices when constructing their overall fixed-income portfolios. To understand how the bond equivalent yield formula works, it's important to know the basics of bonds and understand their differences from stocks. Companies looking to raise capital may issue stocks or bonds, fixed income. Equities have the potential to earn higher returns, but they also carry greater risk. On the other hand, bonds provide a more secure investment option. Not all bonds are the same, some pay interest payments while others, like zero-coupon bonds, are issued at a discount to par and pay out the returns when the bond matures. Analysts rely on the bond equivalent yield formula to compare the return on discounted fixed-income securities with the returns on traditional bonds. The bond equivalent yield formula is calculated by dividing the difference between the face value of the bond and the purchase price of the bond by the price of the bond. That answer is then multiplied by 365 divided by the number of days left until the bond's maturity. To illustrate, if an investor buys a $1,000 zero-coupon bond for $900 and expects to be paid par value in 6 months, the bond equivalent yield can be calculated by taking the face value and subtracting the actual price paid for the bond, and dividing the return on investment by the price of the bond to obtain the return on investment, which is then annualized with the number of days until the bond matures. Here are 3 key takeaways. 1. Fixed income securities come in different forms. 2. Discounted, zero-coupon, bonds have shorter durations than traditional fixed income securities, which makes it impossible to calculate their annual yields. 3. The bond equivalent yield, BEY, formula can help approximate what a discounted bond would pay annually, letting investors compare their returns with those of traditional bonds. Hope this would help. Thanks for watching.